Hi, I'm Norm Plumstead, the President and CEO of Honor Bank, and welcome to part 5 of my series on demystifying banking. Today I'm going to discuss liquidity. Liquidity sounds incredibly boring until you understand the significance in maintaining the health and stability of the banking system. Liquidity refers to a bank's ability to convert its assets into cash without significant loss. So said differently, liquidity is the capacity to quickly meet short-term obligations or unexpected cash demands from depositors. With that in mind, the first thing to understand is that a bank's balance sheet is the exact opposite from yours and mine. So banks effectively borrow money when taking in deposits and then loan those deposits out in the form of residential mortgages, commercial loans, car loans, and so forth. That's why a bank considers its deposits as liabilities and its loans as assets, which is, of course, inverse to the way businesses and individuals think about loans and deposits. Now, banks do generally one of three things with their pool of deposits. The first is, as I mentioned, to make loans. The second is to place them into investments. And then the third is to let the deposits sit in cash. And when you look at a bank's balance sheet, you'll see all three asset components: cash, investments, and loans. Loans aren't considered liquid because they can't easily be converted to cash, which leaves investments and cash, which are the two of the three pillars of liquidity. I'll touch on both, plus the third option, which is borrowing capacity. So the first pillar of liquidity is cash, and all banks are required to keep a minimum amount of cash on their balance sheet, even though it typically offers the lowest return. Why? Cash offers immediate liquidity without risk of loss. The second pillar is a bank's investment portfolio. By and large, community banks view their investment portfolios primarily as sources of liquidity. And therefore, the investments are extremely conservative in nature and as liquid as is practical. In addition to cash and investments, banks also have what's known as borrowing capacity, which is the third pillar of liquidity. Banks borrow money when it's advantageous to do so from a rate perspective, or when they have more loan demand than they can fund using their core deposits. And banks have a variety of sources from which they can borrow, and some examples include the Federal Reserve or the Federal Home Loan Bank. Banks measure and model their liquidity on an ongoing basis. One of the primary methods to measure liquidity is what's called liquidity coverage ratios. And that's where a bank compares its sources of liquidity, its cash, unencumbered investments, and borrowing capacity, to the total amount of deposits. And there are both regulatory and internal minimums that all banks must maintain. Not only do banks measure these ratios as snapshots in time, banks also stress test to ensure that they can handle unexpected events. Banks also think about liquidity in terms of time scale. For example, how quickly can the bank obtain borrowings? Taking time into account is particularly important now when money is moving faster than ever. So one of the responses to the bank failures this spring was that the Federal Reserve created what's known as the Bank Term Funding Program, or BTFP. So the BTFP allows banks more flexibility when pledging their investments, thus creating more potential liquidity should they need it. And equally as important, banks can access these funds very quickly. So in effect, the BTFP offers banks yet another arrow in their borrowing capacity quivers. So that's it for liquidity, that's liquidity in a nutshell. I like to think of it as the oxygen that enables banks to breathe and for the banking system to function properly. If you've got any questions, please add them to the comments section below, or feel free to reach out to me directly on my cell phone, give me a call, or shoot me a text at 231-709-1730. Thanks for watching, and I'll see you back here next time.